I'm just gonna let everyone join up real quick. What's up, Tanish? Savage. Alright, I'm gonna start it there. Let's get straight into it.
It's already uploaded on YouTube. It's time and date stamped. For the buy side here and draw into this old weekly imbalance. This is what we saw today. This is a weekly candlestick. So we can see the weekly chart did in fact expand in the direction I was expecting. We did get the buy side above the high here, and we did trade inside this volume imbalance. For the folks that are asking and mentioning and kind of like talking amongst themselves in Twitter, why am I not using the continuous contract on TradingView? Well, the continuous contract is not going to show you the inefficiencies that the actual individual delivery contract months will. For instance, if we get above this high here, I like this SIBI and I also like this volume imbalance. So it depends on how much continuation we have in price action, but we take one step at a time.
This is true with for XAU. Instead of using gold futures, you want to use XAU forex chart because you're typically more likely to see like these volume imbalances that are formed either with a new week opening gap or new day opening gap. And yeah, price really references them. You could build a lot of bias on them. So right here, he's just talking about he's using the June contract for the S&P 500. So this wouldn't normally be here, but because he's using that contract, it's there.
So the benefit of having a thinly traded contract, because this contract was trading well before it became the front month. Right now we're trading the June contract. If I can base some other form of why prices was used as all right, and here is the daily chart I showed yesterday evening. So here's yesterday's chart. All I did was use the same slide that I created yesterday evening, and now here's what we're going to see today. There's the delivery to the buy side I told you we would see, and we drew into that weekly volume imbalance. Not hard, is it? Not complicated. I'm not trying to bring in every ICT concept I've ever created into one single model. I'm looking for a simple idea. Where's it going to draw to next? I outlined it. I showed you why. I built it from a weekly chart to a daily chart to an hourly chart to a 15-minute chart to a 5-minute chart and a 1-minute chart. I can't make it any easier than this, okay? All you're looking for initially while you're trying to learn under my wing, you're looking for the skill set of knowing where price is going to draw to next. Okay, it's going to go higher, it's going to go lower. I am lending you my experience as a mentor so that way you can study price action with that in mind. It's not that we're trying to create challenges for you to never succeed at. I'm telling you this is where the bulk of your work should lie in the beginning. It's not looking for entry patterns. It's not looking for the new ICT gadget or concept. You want to be focusing on journaling, going back through old data, and finding these repeating phenomena that I'm teaching you, because once you see it.
So very simple what his draw was. So we have these stacked highs, which shows a low resistance liquidity run. That's what you're going to see when you have those stacked highs, as well as that volume imbalance that needs to be filled. And as you know, this is a market maker buy model. It's not super clean, but we come down, we create this smart money reversal. You can see us disrespecting these bearish PD arrays in here, and we could see that continuation leg right here off this distribution.
You can't unsee it. Once you learn it, it can't be unlearned. Then you'll be initiated. That's the cult of winning we have around here. Okay, everybody likes to say we're a cult, and I've gladly accepted that, and we're the cult of winning. You can see here again, no hindsight. Okay, I can't manipulate daily and weekly candlesticks when I told you beforehand. So here's the price action as I mentioned last night. Only thing I did take off the gradients in here, and these little arrows, don't be fooled by that. Okay, all I'm showing you is the key turning points. So when you're doing your journaling and you're logging all of your price data and looking at old moves, you want to be putting arrows there because it trains your eye to see it just like that. And then when you start practicing your executions in the future, not now, you'll see that you'll be entering at these types of levels and with a logic behind it. So last night I took you to this fair value gap here. I said we would draw up into that, and then the buy side and the weekly volume imbalance, just that shaded white area up here. Okay. I also mentioned to go back and watch that video. I said while we were consolidating here, we would likely, because we didn't do this run up here yet, this was all midnight. We were trading in this little area here. I said we were likely draw down into this buy side imbalance, then go higher. We did that very thing here. If it drops just inside of that imbalance, and we're expecting a shallow drop, that run is going to be initialized by a institutional order flow entry drill. And that's a tongue twister. That's why I labeled it an IO.
So this is gonna start my lesson right here because this is exactly what we're gonna be talking about. So if the draw is up here and we have some sort of liquidity forming, right here would be sell side. We're targeting buy side. We want that sell side to develop. And once that sell side is swept, that's the moment we start looking for longs. Because what if we're getting long up here into this little small fair value gap and we have these stacked lows right below us? Well, we're going to get stopped out. Whereas if we simply wait for those manipulations to occur, we're more likely to catch a good move right here. And that's when we're going to see a reversal below liquidity when our opposing liquidity is our draw. So obviously if we're targeting sell side right here, then we'd expect continuation, but we're trading into this BISI, and then that volume imbalance was our main target with this buy side being our secondary target. So I'm going to just show you when to look for a reversal or when to expect continuation. So this week I outlined that we're most likely going to trade up to this high up here. So looking at how price developed today. So actually let me look at ES. I believe it's a lot cleaner. So just looking at price right now, if we're planning to go long because our draw is long and we're not trading until at least 8:30. Let me pull up this. We're not trading until at least 8:30, probably past that. But if we're going to go long, we're not going to go long up in here into this fair value gap. Why are we not going to do that? Because we have all this sell side. We have all this accumulated sell side. And like I showed you before, yeah, we could get long in this fair value gap, or we could take so many longs right here, but they're not going to be high quality longs because look how much sell side we're developing. All these lows. Please mute yourself when you're coming in. So we have all these lows right here. Okay, well, if we're coming up and we're sweeping this high, okay, even though our draw is bullish overall in the week, there's nothing wrong with going short if you know what kind of setup you're looking for. So right here, this is most likely where you'd want to go short. This also has to do with time. Like I said, we're not going to take entries until that 8:30 hits, just because that's when our news embargo lifts for NQ. You're gonna get a lot more volatility. So let's say we're pretty disciplined, right? And we, instead of going short, we're actually just gonna wait for a long setup. Okay, well, we come down, we sweep this low, and what we want to see is, once we've swept that low, we want to see where are we delivering from. Okay, well, we have, don't know who said that. You could kick whoever joins and is talking. Here we go. So we have this BISI. So if we're coming down, we're taking that low, and then we're respecting this BISI right here. Okay, well, it's obviously showing a willingness to possibly want to go higher, especially with this closure right here. Okay, so that's when we're gonna spot these reversals below liquidity. So we kind of have to combine all these things. Our draw was bullish. We took out sell side trading into this BISI, and now we show a willingness to want to go higher simply because of this candle closure. So we're not going to want to see continuation on that move. We're going to want to see a reversal. So in terms of what would be our entry, let me go to lower time frame. Okay, that same area, we have this inversion fair value gap. This is a breaker. And then we also have this fair value gap, which I'm not going to mark out because there's a lot going on. But essentially that's a unicorn right there. That's a really good setup. And on top of that, we have a macro. So that's the cherry on top. And preferably like when we come down, and so in this instance we come down and we swept that low, and then we're trading into the fair value gap. We want to see actually this kind of move. We want to see us come down, kind of respect it, and then one last sweep. That makes the turtle soup. That's what makes the turtle soup, that final manipulation. And that's also creating what is essentially, even though it might not look like it, it's a market maker buy model. So we'd be targeting these highs up here. So yeah, that's how we're gonna use our liquidity. And so let me look back and I'll show you when we can expect continuation. Let me just delete all this. Okay, so if we're coming up and we're taking out this buy side over here, and we have all these stacked lows. Okay, so what's even more significant is we have London and then Asia, and those have not been swept. So if price comes down here and say it sweeps London right here. Okay, well, just because it swept that level doesn't mean we should get long. Even though we have this inversion for value gap that's formed, we shouldn't go long. Why? Because our overall draw, our overall narrative implies that we're most likely to go lower, continue lower. So that's when we're looking for continuation. So we could look for another setup in here. So let me take this off. So even though we come and we disrespect that inversion fair value gap, we have a turtle soup right here. And let me see. there's any lower time frame setups. Yeah, I mean, you could trade any of these. So say we come and we invert this. Even though we're down here, we could still take an entry. Stop above right here. That's a 2-to-1. If we hold lower for our other targets, that could be a 5-to-1. So basically what I'm trying to say is you have to know the narrative and the draw. It's more than just, oh, we swept this low, now let's go and reverse our entire bias. Like, no, you have to look what's going on. And price is always going to draw to these kill zone liquidities. So, London, Asia, and then even our prior day's New York session. That's what price runs on, liquidity. So this would be a continuation move through these liquidity pools. And then as I showed you up here, we swept this buy side. Well, that was the only buy side that was left. So it's likely we're going to go to sell side now. That's our reversal.
FED, just an abbreviation of institutional order flow entry drill. It's a partial entry to a fair value gap, whether it be a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. So either or, and since we have an up close candle here, that makes this a BISI, buy side imbalance, sell side inefficiency. All of the things I just mentioned are by category of a PD array is a fair value gap. But a fair value gap can be broken down into different classifications. This being a buy side imbalance, sell side inefficiency because it's going higher, it's offered buy side. It's imbalanced because it only offers buy side. It's one single candle doing it, so it's inefficient in the sense that it's not offered any sell side. But if the market's bullish, as I've been indicating to you that it is, it's going to go down into this area here and keep some of that open. So we did that very thing here. We dropped down into that candle's low just a little bit and then rallied up, created another buy side imbalance, sell side inefficiency with this candle here. This candle's high, that candle's low, frames this as a buy side imbalance, sell side inefficiency. We also have a breaker here. So the market trades down into that. Also, consequent encroachment of this gap. This is a daily fair value gap. This was the daily discount fair value gap. Remember the two areas here on the daily chart. Go back and watch last night's video. You'll get better insights by doing that all over again. And I promise you, it's not a long video. You're welcome to speed it up at 2 times the speed. But the price goes down into consequent encroachment, which is the classic optimal trade entry that I've taught many years on this channel. But it's coming back in to touch and reprice this candle's high. So once it hits that, then it's permitted to leave that range. Once it trades above this.
So what that's called, it's called immediate rebalance. So we're coming down and we're actually filling in that entire fair value gap. Alongside, he was talking about this inversion fair value gap. We touch that CE point, and you're just combining all of these inefficiencies. He even said this breaker, inversion fair value gap, then that immediate rebalance, we're likely to run up higher after that.
High, this becomes a balanced price range. So we can trust that it's going to go higher. Higher where? To the buy side here, and then dig into that weekly volume imbalance, which is what we see it did here. Dropping down into a 15-minute candlestick chart, you can see that we had that institutional order flow entry drill. It drops down here during the morning session. This is a Judas swing. It rallies up. What is a Judas swing? It's a fake move. Okay, so it rallies up, creates a 3-drive pattern. I did 2 trades in here. I shared that on Twitter just because people ask all the time, did you do anything? So I did. And then the market went down, dropped into a fair value gap here, and then rallied up. And then I chose to engage the afternoon session, which was a silver bullet trade for the PM.
Just something I want to mention is ICT, he's always focused on what's the main draw, where is price drawing to. So even though we create technically an inversion fair value gap, so a lot of people think, oh, I need to look at the lower time frame, the 5 minute, the 1 minute, and they think that's going to determine where price is going to go. But you have to look at the narrative and where is the draw going to? We already outlined we're going to buy side. Why are we instantly going to flip our bias? Just because of this fair value gap, and it's respecting right here. Yeah, it's respecting on a short-term level, but if we're looking at the higher time frame, we could see that our price hasn't drawn up to where we're planning it to go. So instead of looking at that as a short opportunity, look at that as a long opportunity. Look at, okay, if we come up above this SIBI that's supporting price lower, how can we get it to support price higher? So once we trade up above it and we show a willingness to disrespect it, that's when we could look for a long setup.
Session. And let's take a closer look at that morning session first. So we have the 3 drives pattern here. 1, 2, 3. Institutional order flow entry drill down here. After taking sell side out, it rallies. Then we have the short-term reversal pattern here. This is a classic price action pattern. It's really good to indicate that we're likely to see some measure of retracement. It can be an all-out reversal, but because we have unfinished business, which is that weekly imbalance up here, that weekly volume imbalance specifically, NASDAQ has done outstandingly on the upside. As I mentioned, I've been coaching along with NASDAQ being the leader of the upside, and it would draw ES up higher in sympathy. So this is a 6 sister concept. I'm trading the pair that has lagged. Okay, I did trade in NASDAQ today also. You can take a look at that on Twitter. I showed the examples and executions there.
So what six sister is if we're digging deeper, having deeper retracements on ES in this instance, and NQ shows more bullishness, sometimes we get better opportunities trading the one that is technically weaker because we're digging down deeper. Well, if we're taking that trade, we're going to get a higher RR. Now, sometimes it could backfire. You'll see that it doesn't move as much, but in this instance, he's showing that price is going to move just as much if you're trading the 6 sister, which is the weaker pair in this instance. I also wanted to mention how it's not a bad thing to see a retracement, because say we're coming down, we're trading down 2 p.m. So that's our PM silver bullet, and price is just developing right here. And we have, now that we've traded down, we've retraced. We have this high, we have this high. So this gives us greater conviction to come in here and take a long in here. Like, that's going to be a better setup than it was before, because you were in a higher premium. If you're trying to get long up here, you're in a higher premium. Now we're in a discount. You could see, even though I'm not measuring it, you can see from this high to this high, that's below the 0.5 level. That's around OTE. So that's even a better setup than us trying to get long in here. So I just wanted to mention that.
But I wanted to teach you using the 6 sister concept, because I kind of the flavor of the month, ICT flavor of the month concept, using this idea that it will want to catch up to what the NASDAQ has done. And we see that here really moving to an upside run into that weekly volume imbalance with an extrapolation that was just really, really nice to be a part of this afternoon. We have a breaker here. So we have high, low, higher, high, extend that through. That's this little retracement here. It broke down just to clear out the sell side here. Then we entered into the New York PM session, which is 2 o'clock to 4. And then we had some fair value gaps and such. And then the final hour of market on close macro that I've been teaching vaguely, which will be taught in great detail in my books that are coming out. And everyone that keeps asking on Twitter, when is
So I'm just gonna tell you what that is instead of you waiting for his book to come out. That's never gonna come out. So from 3:15 to typically 3:45, you're gonna have the last hour macro. It's gonna be rush hour. So if we haven't ran to our target, we're going to run at that time. So you could see us kind of like hanging out right here. And then as that macro hits right around here, you see that displacement. And then you could see us trading up into this BISI. And then once we have that respect, we just run straight up to our target. And so that's very common. If you look at 315 to 345 on the New York session, you're going to see a large run towards liquidity. And sometimes it's a reversal, but usually it's towards our drawn liquidity if we haven't hit it yet.
This is my first book going to be released. I set a challenge for all of you as a 1-minute chart. Imbalance refined into that fair value gap here. It drops down in, clearing up relative equal lows here. Before we get to that, let's look at the 3 drives pattern. We have consequent correction of this imbalance, runs above this short-term high. You watch me do a execution on partials here. I took a long on a fair value gap, took partials here, rolled the stop to better than break even, came back, hit my stop, and then once more I went back in and went long once more above the highs. I took partials, rolled my stop to better than break even, and it came down and stopped me one more time. I was trying to position myself because I was going to be away from the charts throughout the afternoon. I was with my wife and driving in a car and riding in a car, and I can't be in front of my desk. So I'm looking at everything through my phone only, which is something you don't want to do. But for practice sake and giving you all examples on Twitter to follow along, that's the best I could do today. The market broke down. We had the breaker here. Really nice run to that breaker and fair value gap right there. That right there. This, folks, right here. This thing right here. That is a complete model. We have a higher structured, not that it's higher time frame, but a higher structured breaker. Okay, a breaker is a low that has a high to the left of it and a higher high to the right of it. Okay, so it's high, low, higher high. Once this low is broken, it is here. We have an imbalance. That little imbalance right there, that fair value gap that's not highlighted, it's trading up into that and then hitting the breaker. This is also an optimal trade entry. It's also trading into a what? Bearish order block, which is...
So he's just mentioning all the confluences we have right here. But you could see like it's not necessarily a high quality setup because we don't have any higher time frame narrative to go off of. But all he's simply saying is you have all of these PD arrays combined together. You have the breaker, which is a clear breaker. We come up here, we take out that high. We have this, the lowest down close candle is going to be our breaker. He's also talking about this order block and then this BISI, and you could see like a clear respect of it, but that's just on the lower time frame.
Hour. Look at time, 2:15, 1 o'clock. So in that 1 hour period between noon and 1 p.m. New York local time, we have now classic enticement for retail traders to see that as support. So that level right there is going to have a lot of sell side liquidity. And the market runs from the breaker down into that, hits it, and trades into the imbalance right here, which is institutional order flow entry drill as well. And this is also a fair value gap. This nice little retracement into that, and then delivers harshly right into that fair value gap.
Again, kind of talking about liquidity. So if our higher time frame draw is going to be our buy side, up above here, and we see this develop in price. You see two stacked lows. This one obviously hasn't swept yet, and so they're just two stacked lows. Some people might be unsure what to do in this situation, but all you're going to do is you're going to wait for that sell side to be swept, and you're not going to look for an entry until that's swept, and then we get another market structure shift, and we're likely to see a leg higher because we're generating a lot of liquidity when we're having these stacked lows. We also even developed this low. So now we have 3 stacked lows. We're capturing all of that liquidity, and we're likely to run higher after that.
Moving into the afternoon, we can see that turn here. We rally up, consolidate, and then starts to rip higher, attacking what? The buy side here, then the old buy side liquidity pool, and then the weekly volume imbalance. So it's very quick run inside of the PM session, which is 2 o'clock to 4 p.m. New York local time. This is your PM session silver bullet. You get 2 chances here. 1, 2 rallies, and then the final market on close macro, which is the last It's 315 to 345. In that window, you'll get another opportunity to set up a run for liquidity that has not been managed or engaged for that particular day, where the market fills the numbers, and it runs up, hits the buy side, hits the weekly volume imbalance as well, and just beautiful delivery. Beautiful delivery. All right, you can see again, here's that silver bullet, which is between 2 o'clock and 3 o'clock. So between 2 o'clock and 3, there's the silver bullet. One more little extra opportunity that's post 3 o'clock, but still using that setup here. So it's being reclaimed at fair value gap right there, and it rallies up. Trades back down in. Look real close. You see this inefficiency here in that candle's high? How price runs through this shaded area. All of this area here gets repriced to. See that? That candle's low. Trade up into it here, a little bit higher, and then trades back down. It stops right there. Why is it stopping right there? Well, it only needs to go down to this fair value gap right there. And we've already traded up. Once this candle went down, the next candle.
So he has a sorry, he has a New York PM session, right here from 2 to 4. So typically we have our PM silver bullet from 2 to 3. But the reason why he has the entire range marked out right here is because right here you can see at 315, like I mentioned, 315 to 345, we're likely to see that run up in that rush hour. What he's talking about right now is this SIBI that turns into a IFEG. So we come up, we respect it, we respect that midpoint. Then we have, that would be our setup. That would be where we would want to enter. We could enter down here, but as you could see, like we tag it. So there's that possibility that we're not going to go higher. But once we see that willingness to trade up above it and disrespect it, we're likely to see that as support. And I'm just going to skip ahead a little bit.
High of the day in a second. This is the power 3. This is what the daily candlestick looked like from 9:30 open. Small little movement lower, rallied up, creating the high of the day. I'll get into that high of the day in a second. And then closing here. So we have another classic buy day. Open, decline, Judas swing, rallies up, closes on the high. Working that fair value gap. The 9:30 open was essentially near the low of that shaded fair value gap. Here is the opening range gap, which is the regular trading hours. You can see that difference between where we closed previous day and where we open at 9:30, that little shaded area. I hinted at something that we'll talk more about in the book, because these types of things are just too good. They're just too good for YouTube. There's too many yahoos out there trying to take my concept.
So what he was talking about, I'm not entirely sure where the midnight price is, but I know midnight price would be somewhere, let me see, be somewhere, well, he has regular trading hours on, so it'd be somewhere around here. But we trade, yeah, I think it'd be right here actually. So we trade down below it. And then when you think about it, what power of 3 is we're going to come down and we're going to manipulate below that opening price, right? Which is down here. Okay, well, if we manipulate below that opening price, the rest of the day is going to be green, right? We're going to have that bullish expansion. So if you think about it from a higher time frame perspective, why are we going to worry about everything that's going on in here? So like all of this consolidation, if we could get in below at that manipulation down here, then none of this is going to matter. And that's why power of 3 is so powerful. It's so important, because we could completely negate all this consolidation. All of it doesn't really matter. We're just trying to get in below that manipulation so that we could ride the rest of the day and not have to worry about those lower time frame fluctuations.
Steps. Okay, make mentorships off of it. No credit to me. I'm not gonna it, and it's mine, and everybody will know that it came from me, because we've talked about it. Okay, and I stole it or rebranded it from them, which is nonsense. But I talked about how you can take this imbalance and multiply that out and project it up, much like I taught with my central bank dealers range, and much like I taught with flout, and how I amplified what everybody that, I taught with central bank dealers range, and much like I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout, and how I amplified what everybody that, I taught with flout was aware of the Asian range for a long time. I supercharged that and taught you how to use it and make it better. Okay, and I taught you in terms of standard deviations. But you can do that opening range gap the same way, and you can do projections higher. And then we have an overlap of negative 11 standard deviations, and at price comes in at 40.
So he's talking about regular trading hours. So what that means is right here, I believe it's from 4 to 9:30. So that's during the time where stocks aren't necessarily open. It's like post market or pre market. And so there's a lot less volatility. So that's why on NQ and ES, you see the bulk of movement during our New York session because we have equity open, which is stocks moving. And during London and Asia, they're not really open. So you're not going to see as much price movement during those times. That's why it's best to trade that New York session, that AM New York session. But what he's referring to right here is from 4 to 9:30, which is when stocks are not open. He's measuring out that gap into what would be negative 11. So he's calculating what's our potential expansion right here. And he's lining it up with that volume imbalance that we have, which is this white part.
4214.75, which is the basis of why I took my exit right at that low, which would be just a hair below, was all discussed as it pertains to the PM session, silver bullet, and the final 15 minutes after 3 to 45 minutes after 3, that 30-minute window. That is a market on close macro. The algorithm generally will run for liquidity. Now, if the liquidity has been tapped, that means a higher time frame liquidity pool or target's been met, then it usually won't spool and start running. There's no need for it to do anything. Then if it's done that, the last 15 minutes of trading between 3:45 and 4 o'clock, you'll get some kind of little sputter move, which is maybe it's good for 5 or 8, maybe 10 handles, maybe, but not terribly explosive. But like this, I told you last night what to expect. We were going to look for 4206. We were going to look for a 15-minute premium fair value gap, and we look for it to draw up into that weekly volume imbalances, that shaded area, and it delivered like gangbusters. So this is what we have.
So just what I talked about before, that market close macro, 315, 345. That's when you start seeing this displacement. And then right here towards the end of it, we come up and we tag that level we were looking for. And we also this volume imbalance, which we slowly just grind up and get to. Probably skip in here.
Right time, their stops is resting right above here in the form of a buy stop. Why would it be advantageous to trade there or above this level here or up into this weekly volume imbalance? Because smart money will look to distribute their longs there. So offset distribution occurs with smart money buying the sell stops, selling some above this high, selling some above here, and above here. And they liquidate that. And that liquidation of their longs above here, they're selling above here, which gives what? The retail traders the liquidity to be a buyer of when they're chasing price. When it breaks out here, who wants to buy that? Breakout artists. And the smart money selling their portion that they went long down here to there, which is why I'm teaching and teach my students to sell long positions partially above old highs and to cover short positions below old lows. That's what smart money does.
So the way he explains it is right here, we're capturing all that liquidity. These were the same two levels I was talking about earlier. So once we're going to take these buy orders right here, they're going to come in the form of buy stops, which is sells, but smart money is buying those sells. So every time we come up and we take one of these, smart money is going to be selling as well their buy positions. So that's why it's good to take partials, because you never know if we run out of liquidity, we run out of that momentum. We're going to want to take that partial, so at least we get something out of it.
It does not follow retail patterns. It does not look at moving averages. It does not look at breakout strategies. It doesn't do that, okay? They don't do that. the algorithm will set up scenarios where retail traders with that mindset will fall victim to it. And you don't want to be in that category. You don't want to be a classified neophyte forever in trading with retail logic, never coming to the understanding of what these markets are actually trying to do and how they book. So hopefully you found this one insightful. Until
You are my liquidity. Okay, I'm just gonna cover just like one last aspect, which is the same thing, liquidity, kind of what we were talking about. Let me just go back a little bit more. So if we're coming down, this is at 9:30. If we're coming down and we're taking this low, we've already taken sell side of Asia and then the sell side of London. So if we're seeing that movement, and then we're probably not going to get long in here because it's not before equity open. And that's where time comes in. We're not going to see those large expansions until after at least 8:30. So once we see that sell side taken and we see some kind of willingness to trade up higher like this, it's an inversion fair value gap. We create a normal fair value gap right here. So this is where we're not going to want to see continuation to the downside. Why? Why not? Well, because based on our time, which is 9:30, many times 9:30 is going to come down. It's kind of like its own macro. It's going to sweep one side and then it's going to run the other side. So if we come up and, yeah, we respect it once right here, but once we've disrespected it, we're not going to want to see any more sell side. If we came up right here and we like swept this high and then we continued respecting this SIBI, then maybe there's a possibility we run lower because we have more liquidity. But simply looking at our London and Asia high, it's likely we're going to come up and run up into those highs. Let me jump on a lower time frame. So that would be our entry. Oh, I messed up. Be right here. Then let me mark out this high as well. Not sure if it hits it. So we come up, we take both of those levels. Now, this is where you might want to see continuation, and that's not where you're going to say, oh, I'm going to add more positions or I'm going to get in again. No, you're going to leave a partial, a runner on for that last target. You can see right there, it runs up and it takes that high. So right here, this liquidity is going to be our reversal liquidity. Once we come up here, we can expect some kind of continuation because our overall move was it's a buy model. We're going to expect some kind of continuation through that liquidity. We do have a small retracement, but that doesn't necessarily mean, oh, we should go short now. At that point, you should be done trading. Once we've took out this sell side and then we took out Asia and London buy side, that day you're kind of done. You're not looking for any more moves. But if you have that partial on, you have that runner on, you're going to want to hold until that final target. So yeah, the focus today was simply when you're going to find a reversal, which is going to be during macros. It's going to be near the open, and it's going to be when we have a opposing draw. We're not going to look for continuation below that liquidity. We're going to look for it to be swept, and then we're going to be targeting that narrative, which is these highs, because they're London and Asia, which price tends to draw up to because we're going to have more liquidity during those levels because it's a active trading session. There's more volume in here. There's more going on. So that's why price is going to target those highs. So that's the lesson today. If you guys have any questions, I could answer them right now.